Hey everyone, welcome back to Corporate Decoder. Today we're diving into Karman Holdings 10K filing, and trust me, with all the financial restructuring, it's like trying to assemble a rocket ship with IKEA instructions. Prepare for a deep dive into their mission critical systems. This is their annual report, basically a year in review required by the SEC, filled with details about how they performed and what risks they see on the horizon. Karman specializes in designing, testing, and manufacturing systems for things like missiles, defense, and space programs. They're the folks who make sure rockets don't blow up prematurely. The report covers the fiscal year ending December 31, 2024. So let's buckle up and get started. First things first, the filing confirms Karman's been around for a bit, with a commission file number showing they're officially on the SEC's radar. They're also incorporated in Delaware, a popular choice for businesses. They have their common stock listed on the New York Stock Exchange under the ticker symbol KRMN, so they're a public company now. Good news, the SEC filing is marked yes to confirm they've submitted their interactive data files electronically. In other words, they are playing by the rules. Karman is pulling in info from their prospectus filed back in February 2025. So this report isn't the only place to get the full story. Some key sections in this report are incorporated by this prospectus. Now, before we get too far, there's a note about something called a corporate conversion. Basically, they change from a limited liability company to a corporation. It is important to understand who we and our refer to depending on the time period. The change happened so that the entity that offered its common stock was a corporation rather than a limited liability company. They're using some financial measures that aren't strictly by the book accounting. These are called non-GAAP measures, including EBITDA, adjusted EBITDA, and adjusted EBITDA margin. This can be helpful, but it's important to remember they're not replacements for the standard numbers. Karman mentions they get industry info from third-party sources. So they are getting the information about their industry and market from external sources, so it may not be 100% accurate. Here comes the legal language. Karman notes the report contains forward-looking statements, which means they are predictions that are not guarantees of future performance. These statements come with risks and uncertainties that could mean actual results differ. So they are saying to read it carefully. Scroller type in one business scroll. Karman is focused on building and integrating and acquiring other companies. They acquired additional companies to create a platform with complementary capabilities and robust intellectual property IP. According to the report, Karman wants to expand what's possible in space and defense. Their business model focuses on integrated system solutions, which they believe gives them a competitive advantage. For the year ended December 31, 2024, they generated $345.3 million in revenue, a 23% increase from the prior year. They had a net income of $12.7 million. Have to see where that revenue comes from. The first market is hypersonics and strategic missile defense, which accounted for 33.2% of their revenue. As near-peer threats continue to emerge and focus on hypersonic capabilities, Karman hopes to be there to develop and produce missiles. Next up is tactical missile and integrated defense systems, accounting for 33.5% of revenue. With ongoing conflicts and the need for missile replenishment, they believe demand for these platforms will remain strong. So lastly, space and launch, accounting for 33.3% of the revenue. They believe that the space market will continue to benefit from growth from the emergence of new launch providers, increased government spending, and the introduction of new space applications. Karman believes they occupy a differentiated part of their customers' supply chain. This basically means there are fewer competitors offering the same integrated solutions they do, because they provide technical design capabilities and component expertise. One of the company's competitive advantages, according to the report, is being a mission-critical concept to production integrated systems provider. They are also differentiated by their technical capabilities and IP intellectual property, which includes patents, trade secrets, and proprietary know-how. The three key categories: design IP, proprietary IP, and process IP. Karman is focused on delivering quality integrated system solutions and believe that their focus will create an opportunity to further expand shipset on next production phase programs. They have a rigorous approach to acquisitions and are seeking companies with strong intellectual property and capabilities to create more integrated system solutions. They target a goal of meaningfully improving an acquired business adjusted EBITDA over a 3-year time frame post-acquisition. A material portion of their revenue comes from US military contracts. If violations to procurement laws happen, there could be civil or criminal penalties. Government contract numbers are huge to them. Karman is subject to various trade laws and regulations. They are also subject to data protection laws like the California Consumer Privacy Act and the European Union General Data Protection Regulation. This means they are at risk for penalties regarding economic and trade sanctions. The primary raw materials used to produce the company's products include composites, metals and alloys, specialty chemicals, and energetic materials. Supply chain disruption could impair the company's ability to manufacture. Scroll item 1A risk factor scrolls here. Here's where things get interesting. This section outlines the potential dangers to Karman's business. They rely on a few big customers for a large portion of their sales, 50.7% of revenue during the year ended December 31, 2024. If one of them decides to cut back, Karman could be in trouble. Also, they are a prime contractor under several US General Services Administration contracts and government-wide acquisition contracts, LEPT GWACs, the GSA and GWACs. The GSA and GWACs other government agencies losing their GSA could hurt their ability to attract new business. If they can't keep up with the increasing complexity of their business or handle their expected growth, it could negatively affect them. This means if they can't handle the complexity and growth, they could fall behind their competitors. Acquisitions are a big part of their growth plan. If they can't find suitable companies to buy or integrate them well, that could also cause problems. They rely on their key people. Losing them, especially key executives, would have a very negative impact on the business. If there are any issues with getting components or raw materials, it could cause delays in manufacturing and delivery, harming their business. This means they are at the mercy of their suppliers. Their manufacturing facilities are subject to risks like natural disasters, which could disrupt production. All of their factories being located on leased locations also presents risk. They may not realize the full amounts reflected in our backlog as revenues. So the money in their order book may not translate to real cash coming in, because due to the US government's ability to not exercise contract options, they may never realize revenues from some of the contracts that are included in their backlog. Karman's business may be materially adversely affected if they were to lose their government or industry approvals, if more stringent government regulations were enacted, or if industry oversight were to increase. They also discuss how technology failures or cybersecurity breaches could seriously harm the company. Government budget changes could directly affect their financial performance because a significant portion of their net sales is generated from the military defense market. They may be harmed by intellectual property infringement claims, which are costly. Their variable interest rate debt could hurt their ability to react to changes. They need to be able to generate cash in the future, which is, to a certain extent, subject to general economic, financial, competitive, legislative, regulatory, and other factors that are beyond their control. The company has revealed they have found material weaknesses in their internal control over financial reporting, which, if it continues to be a problem, could make investors lose faith in their numbers and also make it harder to access capital markets in the future. Since they're an emerging growth company, some of the usual rules and regulations for public companies don't apply to them. This could make their stock less attractive to some investors, as the company isn't forced to abide by those public company rules. The existence of anti-takeover provisions which can delay or prevent a change of control towards scroll item 1B unresolved staffum scroll. Section simply states none, so the SEC doesn't have any outstanding issues they need to address. Scroll item INSI KED GABA security call SIKES SEBI K item 1C cybersecurity scroll. They do have management positions and committees responsible for cybersecurity. They also have periodic reporting requirements for management to be informed, and the board of directors coordinates risk assessments. Okay, let's get to the real juicy part of this report. Total revenue in 2024 was $345. Look at that backlog, which representing $9.8 million, which is great news because 2023's funded backlog was about $428 million. So a lot of orders coming in. Cost of goods sold came in at $213 million. General and administrative expenses, which is everything from rent to office staff paychecks, was $44.4 million. This led to a net income for the year of about $12.7 million for a net income margin of 3.7% or $12.7345 Breaking the revenue down, hypersonics and strategic missile defense, $114, $6 million, space and launch, $115 million, tactical missile and integrated defense systems, $115 in zone and $15 evenly spread out. The company listed some major control weaknesses. The most concerning in my eyes is the company did not design and maintain effective process level controls for all significant business process cycles. So that does not sound good. They refinanced all outstanding obligations under the TCW credit agreement and provided for the issuance of a new $300 million term loan and $50 million revolving line of credit. This is a big change in the debt structure of the company and probably was very important for future growth. That new term loan will mature April 1, 2032. The company agreed to purchase a company named Innovative Precision for $90 million in cash, and the signing of the agreement makes some of the company's assets difficult to value. And they do have a code of business conduct that applied to all company officials. Now, looking at all that and putting my Warren Buffett hat on, here's my take. Karman's numbers are impressive. Revenue growth is strong, and while profitability is modest, 3.7% net income margin, the diversified revenue streams and backlog suggest stability. The biggest problem, as highlighted by the report itself, and as with other defense companies, remains their reliance on government and defense programs. These are not recurring, they are just large contracts that can go away very quickly. Some also high levels of debt and variable interest rates, coupled with material weakness, could be a sign of trouble. In overall, Karman looks like a promising company in a growth industry. Thanks for watching. Make sure to smash that like button, leave a comment, and subscribe for more Corporate Decoder.